This weekend in China, the world's second largest economy, a meeting could change the country's fate forever. Its top Communist Party brass convened for a 4-day meeting, and their decision could have global consequences. Patrick Chovanec, the chief strategist at Silvercrest Asset Management, joins us with the details. Hi, Patrick.
Hello.
So, what are the stakes at this meeting? What's happening?
Well, you've got a lot of reforms that are on the table, and the Chinese economy is slowing, and the Chinese leadership has admitted that the current growth model has really reached its sell-by date, and they need to embrace these reforms to go forward. But there's a lot of pushback, and there's a lot of uncertainty about what will happen if they actually do engage in these reforms.
And right now we're essentially talking about an outline of a plan that's on the table, but what are some of the big ticket items that they're going to be talking about potentially implementing?
That's right. Well, the name of this plan is the 383 plan, and it embraces a whole host of different things, and I think that's actually a sign of how long they've delayed. A lot of these reforms have been on the table for years. It goes from hukou reform, which is the mobility of migrant workers in China, to financial reform, how the banking system works, dealing with the immediate problems in the banking system, but also the long-term efficiency of the banking system, state-owned enterprises, what to do about that. There are a whole host of things that they need to tackle.
And it seems like the issue is when you go through with a major reform like this, I mean, you do risk slowing down growth even more. So what's the risk not only to China, but to a global economy that's come to rely on China's growth?
Well, China's really at an inflection point, and it's going to have to shift gears from one kind of economy to another. And that will mean slower growth, at least in the short run. But the quality of growth is what matters, not just the quantity. And so I think they really need to move away from chasing after hitting GDP targets to focusing on the quality of growth going forward and moving away from this dependence on credit-fueled investment growth, which is really digging the hole deeper, and shift towards a more balanced economy that's driven by consumption.
What's at stake for China if they don't do this, if they basically punt again?
Well, the conventional view is that they have 2 or 3 years to sort this out. I tend to think that they have months to sort it out. And when we've seen over the past, over the past 2 years, we've seen the Chinese economy slow significantly, and we've seen debt rise significantly. And right now, they're in a situation where it takes more and more credit expansion to produce less and less kick for the economy. Like I say, the Chinese leaders have admitted that this is really not a way forward. And we saw what happened when they tried to take the punch bowl away, or even try to dial back credit expansion a little bit. In June, the entire interbank lending market seized up, and I don't think that the problems that caused that have gone away.
And if you're an economist or a policymaker here in the U.S. and you're watching this meeting, I mean, what does this mean for the U.S.? What's at stake for us?
Well, for the United States, actually, we've been trying to encourage them to rebalance their economy, both externally and internally. In the long run, a Chinese economy that's driven by consumption, that's more balanced, is good for the United States, especially in terms of what the U.S. produces, food, finished goods. If you are feeding China's investment boom, like Germany selling machinery, or Australia selling iron ore, or Chile selling copper, this shift away from investment-intensive growth is going to hit you hard.
All right, Patrick Chovanec, thanks for being with us.